Section 3, Using a Car for Business. Our objectives for this section are to decide whether to use the actual expense method or the standard mileage allowance, understand basis, depreciation, and the Section 179 deduction as it applies to cars and trucks, to know what kind of car expenses are not deductible, and discuss options for reporting employer-provided cars. Part 8. Bob buys a new car. A car is the first choice for transportation for many people, and if you use your car for business, you may be able to write off some of the costs. According to the IRS, car and truck expenses are typically the second largest category of deductions for sole proprietors, right behind wage expense. To take car and truck deductions, however, you must follow specific record-keeping rules. As we already discussed in prior sections, there are two methods for deducting costs: the actual expense method and the standard mileage allowance. Both methods require that you maintain good records for business driving. What is a car for tax purposes? A car is defined as any four-wheel vehicle made primarily for use on public streets, roads, and highways that has an unloaded gross vehicle weight of 6,000 pounds or less. A truck or van is a light truck or van if its unloaded gross weight is 6,000 pounds or less and is subject to rules similar to those for passenger cars. Excluded from this definition are vehicles used in business for transporting people or for compensation or hire, such as a taxi, ambulance, or hearse. Bob has been thinking about buying a new car for some time to use in his appraisal business, as his 1973 Gremlin has over 300,000 miles on it. He would like to get a car that gets good gas mileage like a Honda Civic. But after he went to the annual car show, he decided to buy a Corvette because he liked the style. The Corvette was pretty expensive, but Bob knows he can get some good business write-offs from owning a car. Bob will use his new car 100% for business. He has another car, his wife's, which he uses for all his personal errands. Which method should Bob use? Bob must decide whether to use the actual expense method or the standard mileage allowance. He can choose either method whether he owns or leases his car. Most people choose the method that yields the higher deduction. Several factors affect which is the better method, such as the number of miles you drive each year and how much your actual expenses are. Bob decides to put pencil to paper and look at the actual computations of his estimated costs to decide which method is better for him. First, let's look at interest on a car loan. Deduction for interest on a car loan depends on your employment status. Since Bob is self-employed, the interest can be treated as a business interest. Corporations can also fully deduct interest on loans for cars purchased for the business. If Bob was instead an employee, he could not deduct interest on a car loan as a business-related expense. The interest on a car loan would be considered a personal expense. Next, let's look at personal property tax on a car. Personal property taxes paid on a car used for business is another expense that depends on your employment status. As a self-employed person, Bob can deduct any personal property tax paid on his car as a business expense. Again, corporations can also fully deduct personal property taxes paid on a business vehicle. Oddly, some states charge personal property taxes on business items. An employee can only deduct personal property taxes as an itemized deduction on the individual's Schedule A. Now let's take a look at depreciation. Car owners who use their car for business can recoup some of the cost of owning the car through a depreciation deduction. Several factors affect the amount of this depreciation deduction, such as the basis in the car, the percentage of business use versus personal use, whether you claim a Section 179 deduction, covered in a minute, when you buy the car, which depreciation method you select. So let's look at each one of these factors in a little more detail. How much is the Corvette depreciation? Cars are classified as 5-year property under the Modified Accelerated Cost Recovery System, MACRS, the depreciation system currently in effect. Bob paid $56,000 for his new car. You might think you could divide 56,000 by 5 to get the annual depreciation amount, but that would not be correct. There are a number of rules that limit the amount of depreciation that can be claimed in any one year and act to extend the number of years for claiming depreciation. The first thing we have to look at is what is Bob's basis in the car? Bob traded in his old Gremlin, which had an adjusted basis of $500. His new Corvette cost $56,000. His basis in his new car is $56,000 minus the trade-in value, or $500, which equals $55,500. The basis is usually how much you paid for the car. Since Bob traded in an old car, the basis of the new car is the adjusted basis of the old car plus any cash payment he made. A loan is considered the same as cash payment when calculating the basis. So if Bob, for example, made a down payment of $1,000 and financed $54,500, his basis would still be the same, $55,500. Luxury and sales taxes are not deductible, but instead are added to the cost basis of the car. The cost basis is used to calculate depreciation and also later gain or loss on sale. If Bob had bought an electric car and received a qualified electric vehicle tax credit, he would reduce his basis by the amount of the tax credit. Now let's talk about the calculation of percentage business use. Bob uses his car entirely for business, so he does not have to calculate percentage business use. His percentage business use is 100%. He has another car which he uses for personal driving. If you use a single vehicle for both business and personal driving, you calculate business miles driven divided by total miles driven for the year to determine percentage business use. This business use percentage is then applied to total auto expenses, including depreciation, to calculate your auto expense deduction. You must keep a written record of your driving regardless of which method you choose, and we will discuss the written records later. The Section 179 deduction, also called the first year expense allowance, is a one-time deduction for the cost of your item. After you take a Section 179 deduction, you can depreciate the balance of the basis each year until fully depreciated. The Section 179 deduction rules were made permanent in December 2015. For 2015, the deduction limit was $500,000. For 2016 and forward, the deduction cap is indexed to inflation. For 2016, due to low level of inflation, the amount remains at $500,000. Also in December 2015, the 50% first-year bonus depreciation for qualifying new business assets was extended through 2017. Combining bonus depreciation with the Section 179 deduction can lead to big tax savings. Unfortunately, there is a dollar limit on the amount of depreciation allowed for a car used in business. For 2016, the limits are the same as they were for 2015 cars, but $100 higher for trucks and vans for the first and second years. The first-year dollar limit is $11,160, which is $3,160 plus $8,000 of bonus depreciation. So whether you take a Section 179 deduction or depreciation, the maximum you could take is $11,160 in 2016. For a light truck or van, the maximum deduction in 2016 is $11,560 with the $8,000 bonus depreciation. You do get a higher deduction in the first year by using the Section 179 deduction due to limitations imposed by the half-year convention or the mid-quarter convention. Claiming the Section 179 deduction. The Section 179 deduction, also called first-year expense allowance, is a one-time deduction for the cost of your item. After you take a Section 179 deduction, you can depreciate the balance of the basis each year until fully depreciated. The annual Section 179 deduction limit for 2014 is only $25,000. This is quite a drop from prior years, as for example it was $500,000 in 2013. Unfortunately, there is also a dollar limit on the amount of depreciation allowed for a car used in business. For 2013, the first-year limit was $11,160, which is $3,160 plus $8,000 bonus depreciation. So whether you take a Section 179 deduction or just depreciation, the maximum you could take is $11,160 in 2013. For 2014, bonus depreciation was eliminated. Depreciation limits for 2014 are expected to remain the same as 2013 base amounts, so the maximum first-year depreciation would be $3,160 in 2014. For a light truck or van, the maximum deduction in 2013 was $11,360 or $200 more if you included the $8,000 of bonus depreciation. Again, the bonus depreciation has been eliminated, so the maximum in 2014 would be $3,360. You do get a higher deduction in the first year by using the Section 179 deduction due to limitations imposed by the half-year convention or the mid-quarter convention, which we will discuss later. There are some limitations of the Section 179 deduction. You can only claim this deduction in the first year that you place the car in service. A car first used for personal purposes cannot qualify for the deduction in a later year when its use changes to business. So if Bob decided to convert one of his extra cars to business use, he could not take a Section 179 deduction. Section 179 expensing does not affect the limits after the first year. For passenger automobiles, the 2016 limits are $5,100 for the second tax year, $3,050 for the third tax year, and $1,875 for each successive tax year. For trucks and vans, the 2016 limits are slightly higher than 2015, with $5,700 for the second tax year, $3,350 for the third tax year, and $2,075 for each successive tax year. When can you use a Section 179 deduction? As we mentioned before, it's only available the first year of use. Also, the vehicle must be used 50% or more for business. The vehicle can be new or used as long as it is new to you, and the vehicle can be financed or bought for cash, but the Section 179 deduction cannot exceed the net taxable income of the business. So if your business is operating at a loss, you won't be able to take a Section 179 deduction at all. So how do you choose between actual and standard mileage methods? Of course, people prefer to use the method that provides the highest deduction. It's not always clear which method provides the highest deduction, so you often have to calculate your actual expenses and compare to the standard mileage allowance to tell. Either way, you have to track how many business miles you drive. The two main reasons people choose the standard mileage method are it simplifies record keeping, and it can result in a higher deduction if you drive a lot. What expenses does the standard mileage allowance include? The standard mileage allowance takes the place of deductions for gas, oil, insurance, maintenance and repairs, vehicle registration fees, and depreciation if you own the car, or lease payments if you lease the car. But there are still several expenses you can deduct separately, such as towing charges, parking fees and tolls, interest on a loan to purchase the vehicle, and personal property tax to register the vehicle. To be deductible, the parking fees must be incurred when visiting clients or while traveling away from home on business. The costs to park your car at home or at your place of business are not deductible, they are personal expenses. The standard mileage allowance for 2016 is 54 cents per mile. Bob expects to drive 20,000 miles in 2016. If he uses the standard mileage allowance, his car deduction will be $10,800, which is 20,000 miles times 54 cents. If actual versus standard mileage amounts are close, he is leaning towards using the standard mileage allowance because it will simplify his record keeping. Bob calculates his expected expenses. Actual car expenses include all out-of-pocket costs plus depreciation if you own the car. The largest actual car expenses are usually gas, insurance, loan interest, and depreciation. These expenses can also include garage rent, lease fees, licenses, oil, parking fees, repairs, tires, tolls, towing, and vehicle registration fees. Bob estimates his actual first year expenses will be depreciation, $11,160, using the Section 179 provision plus bonus depreciation, gas, $2,000, insurance, $2,000, for a total of $15,160 for his major expenses. Bob decides which method to use. Earlier, he calculated the standard mileage allowance as $10,800, and although the actual expenses for the first year results in about a $4,000 greater write-off, Bob feels like in subsequent years it may be better to use the mileage method. If you choose the standard mileage method, you must do so before the deadline for filing your return. Remember, if you elect to use the actual expense method for the first year, you cannot change over to the standard mileage allowance in later years. But if you start out with the standard mileage expense method and switch to actual, you can. Bob figures that once his car is out of warranty, he may want to switch to actual if his repair bills are high. If Bob changes from standard mileage, he must use straight line depreciation for the remainder of the years the vehicle is in service. Once he switches from standard to actual, he cannot change back to standard mileage. Bob loves to drive fast. He has a Corvette, of course. And on the way to a client meeting, he got a speeding ticket, which had a fine of $300. This fine is not a deductible business expense. Fines such as parking fines or speeding tickets are not deductible even if they are received while traveling for business. Surprisingly, you can deduct your attorney's fees and any costs incurred in the defense of an action in which the non-deductible fine or penalty was imposed. In other words, if you go to traffic court to fight a parking ticket or a speeding ticket, the expenses related to that defense are deductible as legal expenses. If your license is suspended and you have to reinstate it, you may not deduct the fees associated with that process. Only a few days after he bought his new Corvette, Bob's car was hit by a shopping cart in the parking lot, resulting in $1,000 worth of damage. His insurance deductible is $250, so the insurance company paid $750 of the damage. Since his car is used entirely for business, the loss is treated as a fully deductible casualty or theft loss. The part of the loss not covered by insurance, or in this case $250, is deductible as a business casualty or theft loss expense for Bob. If Bob only used his car partly for business, he would have to allocate part of the loss to personal casual and theft losses, which have certain limitations for deductibility. As an aside, some people like to calculate their hourly rate for driving based on the mileage reimbursement. In this example, it took 10 hours to drive 600 miles, and he received $324. After subtracting out the cost of gas, that works out to $29.40 an hour. Just saying. Of course, there is some wear and tear on your car, so you might have to take that into account as well. Now let's discuss conventions. No, not conventions in Las Vegas. Conventions are special rules that work to limit depreciation write-offs. The two conventions that apply to depreciation for cars are the half-year convention and the mid-quarter convention. The half-year convention assumes the car was placed in service in the middle of the year. The net effect is in the first year you're only allowed to claim half the normal rate of depreciation, regardless of when the car is actually placed in service. So even if the car was placed in service on January 1st, the half-year convention still applies and you still can only take half a year of depreciation expense. You don't actually lose the depreciation expense write-off, it just gets moved to the sixth year. But it is kind of misleading that a car is classified as a 5-year property, but you still end up deducting the depreciation for all 6 years. There is another convention called the mid-quarter convention that reduces your depreciation deduction even more if it applies. This convention must be used if more than 40% of all appreciable property that you place in service during the year is placed in service in the last quarter of the year. If you want to maximize your depreciation deductions, you should not buy more than 40% of all your depreciable property in the last quarter. You can purchase property at any time during the first 3 quarters of the year and get the full half year of depreciation. You can use the depreciation tables in IRS publication 946 to determine your depreciation if you have to use the mid-quarter convention. Because of the limits imposed by the half-year convention and the mid-quarter convention, you can get a larger depreciation deduction by using the Section 179 deduction in most cases. Bob decides he needs another type of car to drive his clients around town. He hears about a huge sale, so he buys a used Mercedes for $20,000 in December. He did not buy any other depreciable property this year. Bob intends to use the Mercedes 100% for business use, but he decides not to take the Section 179 deduction for it. Since he did not buy 40% or more of all property in the fourth quarter, the mid-quarter convention does not apply, but the half-year convention does apply. There are two main ways to maximize your depreciation deduction. You can use the Section 179 deduction instead of depreciating to avoid the mid-year and mid-quarter convention limitations, which we just reviewed. And you can buy more than one car, like Bob did. The dollar limits apply on a per-car basis. If you buy 2 cars and use each car at least partly for business, you can usually increase the total dollar limit. Since Bob bought the Mercedes for a second car, he could double his depreciation deduction. There is a special break for large SUVs. You can get a larger 179 deduction by purchasing a vehicle with a gross vehicle weight of over 6,000 pounds, but under 14,000 pounds. This tax break is sometimes called the Hummer loophole. If you buy one of these heavier vehicles, the normal dollar limits for depreciation do not apply and the vehicle's cost can be expensed up to $25,000 in addition to depreciation which can be claimed on the portion of the car that is not expensed. For example, Bob buys a Chevy Tahoe in 2016 that costs $55,000 and uses it entirely for business. He elects to expense the purchase and use MACRS half-year convention for the balance of the purchase price. His expensing and depreciation deductions in 2016 will total $31,000. That's $25,000 expensing plus depreciation of 20% of 55,000 minus 25,000 or $6,000. Although you must check the manufacturer's specifications to see if the weight exceeds 6,000 pounds, some of the popular SUVs that typically do exceed 6,000 pounds are Chevy Tahoe, Cadillac Escalade, Chevy Suburban, Ford Expedition, and Hummer H2. Part 9. Bob disposes of one of his cars. When you sell your car, trade it in for a new one, or lose it as a result of a casualty or theft, you have to calculate your tax consequences. After 1 year, Bob decides the Corvette is too small and he decides to sell it. What is Bob's basis after 1 year? When he sells his Corvette, Bob's gain or loss will be the difference between what he receives for the car and his adjusted basis. His adjusted basis is his original basis minus any first-year expensing and all depreciation. If the car was fully depreciated, anything he received for the car would be 100% gain. When you use the standard mileage allowance, you are considered to have claimed depreciation even though you did not make a separate depreciation deduction. The standard mileage allowance automatically takes into account a deduction for depreciation. You calculate your deemed depreciation according to the number of miles you drove the car for business each year in the years it was used. The deemed depreciation rate for 2016 is 24 cents, unchanged from 2015. Bob's basis is calculated as original basis 55,500, deemed depreciation 4,800, for an adjusted basis of 50,700. What is Bob's gain or loss? Bob sold his Corvette for $47,000. His loss is 51,100, his basis, minus 47,000, which equals 4,100. What if Bob used the actual expense method? If you use the actual expense method and dispose of the car before the end of its recovery period, you can claim a reduced depreciation in the year of the sale. Calculate the depreciation deduction for the full year. If you originally placed your car in service in the first 3 quarters of the year, you can deduct 50% of that amount that you just calculated for the final year. If you originally placed your car in service in the last quarter of the year, you can deduct a percentage of the depreciation based on the table in the section on disposition of a car in IRS publication 946. Bob decides to trade in his Corvette on another car. Usually if you trade in your car to buy another car for business, no gain or loss is recognized. This is considered a like-kind exchange. This treatment assumes the new car is more expensive than the old car, but if the reverse is true, you may have a gain to recognize. If you buy a car by trading in another car, your basis for purposes of determining first-year expensing is only the amount of consideration paid, and it does not include the basis of the trade-in. But for purposes of depreciation, the basis of the trade-in is included in the basis of the new car. There are some potential trade-in issues. If you trade in a car that was used only partially for business, a special adjustment is required in order to calculate depreciation on the new car. You must figure the basis of the old car as if it had been used entirely for business, so you must reduce the basis as if it had been depreciated at 100% business use. This can end up severely reducing the basis of your new car. If the tax basis on your vehicle is higher than its fair market value, a sale can produce a taxable loss. In this case, it may be better to sell the vehicle than use it as a trade-in. Let's imagine for a moment that Bob's Corvette was stolen. It's not really hard to imagine this because, according to the National Insurance Crime Bureau, more than 1 in 10 Corvettes have been stolen during their lifetime. During the 30 years from 1981 to 2011, a total of over 90,000 Corvettes were stolen. Surprisingly, the model year most stolen was the 1984 model. The top theft states are California, Florida, and Texas, in that order. Let's say Bob received $54,000 in reimbursement from his insurance company. If the theft occurred at the end of 2016 when his basis in the car was $50,700, Bob would have a taxable gain of $3,300. But if Bob uses the reimbursement to buy another car for business within 2 years of the end of the year of the theft, then no gain is recognized. The basis of the new car for purposes of depreciation is its own cost less any gain that is not recognized. Part 10. Bob leases a Mini. If Bob leases the car and uses it entirely for business, the cost of leasing is fully deductible, assuming he uses the actual expense method. He cannot depreciate a leased car because depreciation only applies to property that is owned. He could choose to use the standard mileage method instead of the actual expense method if he preferred. If the cost of Bob's new Mini exceeds a certain amount and he uses the actual cost method, he may have to include in income an inclusion amount. The inclusion amount was created by tax law in an effort to equate buying with leasing. Since there is a dollar limit on the amount of depreciation you can claim on a luxury car that you purchase, the tax law also requires an amount to be included in income as an offset to high lease payments on a car that is leased. Essentially, the inclusion amount is an attempt to lower your deduction for lease payments to what it would have been if you owned the car and claimed depreciation. It's based on the value of the car on the first day of the lease term and based on a percentage of the fair market value of the car at that time. For 2016, the inclusion amount applies only if the fair market value of the car when the lease began was more than $19,000. To find inclusion amounts for each year the car is leased, refer to IRS Publication 463, Travel, Entertainment, Gift, and Car Expenses. Does leasing have tax advantages? The main financial advantage of leasing is that it requires a smaller upfront payment to lease, while a purchase typically requires a significant down payment. However, if you drive more than 15,000 miles per year, leasing may not make sense because of the annual mileage limit and the charge for excess mileage. Also, at the end of a lease, you own nothing, while at the end of the same time period with a purchased car, you own or partially own an asset that can be sold or traded for a newer model. Additionally, it is sometimes difficult or costly to get out of a lease prior to the end of the lease term. The possible tax advantage is that you are able to deduct the entire lease charge. With a purchase, your depreciation expense is quite limited due to depreciation limits. Although the inclusion amount is designed to offset this tax advantage, the inclusion amount is often not sufficient to make leasing and depreciation equitable. As a result, you can sometimes get the higher deduction by leasing the same car. Part 11. Company-provided cars and reimbursement plans. Bob thinks he wants a company car. You may need to make a decision about whether you or your corporation should own the car you use for business. The best tax advantages will usually come from having the corporation own the car because a corporation can deduct the expenses of the car fully, subject to the dollar limit on depreciation. If you own the car, you can only claim your business-related expenses as an itemized deduction subject to the floor of 2% of your adjusted gross income. Insurance coverage can be more expensive for business-owned cars than personal cars. In spite of the higher expense, it can still be advantageous to have the corporation own the car. If the car is involved in an accident, this will not adversely affect your personal car insurance rates. If there is a lawsuit involving the car, it is usually preferable to have the corporation sued rather than you personally, since a recovery against the corporation is limited to corporate assets. This risk can be at least partially offset by carrying adequate liability insurance. When your employer provides you with a car to use for business, you may be able to deduct certain expenses. Your deduction is limited to the excess amount of actual expenses that were not reimbursed by your employer. If you use the car for both personal and business purposes, you must allocate your expenses between personal and business. The amount of your allowable expense deduction depends on the amount your employer includes in your income. Your personal use, if anything beyond a de minimis use, is reported on your W-2 as income. You cannot use the standard mileage allowance if your employer owns the car you use. What amount is reported on your W-2? Your employer has two choices he can report: either the actual value of your personal use or 100% of the value of the benefit. When the employer reports 100% of the value of the benefit, it's as if the car was used 100% for personal purposes. This 100% amount is based on the annual lease value for the car, explained later. Whichever amount is reported to you on your W-2 is considered income to you. Your W-2 will indicate whether the 100% method or the actual personal use method was reported. If you use the car in part for business, you can deduct your actual expenses for business use that were not reimbursed by your employer. You would deduct your car expenses on Form 2106 Employee Business Expenses or Form 2106EZ Unreimbursed Employee Business Expenses. There are two valuation methods that can be used for calculating personal use of a company car: the fair market value, FMV, or the annual lease value, ALV. The fair market value calculation uses the estimated cost of leasing a comparable car at a comparable price for a comparable period of time. If the car was purchased in an arm's length transaction, you can use the cost of the vehicle, or you can use one of the safe harbor rules, either the manufacturer's invoice price including options plus 4% or the manufacturer's suggested retail price minus 8%. Using either one of these safe harbor costs, you then find out what it would cost to lease a car of this value. The annual lease value is set by the IRS and depends on the fair market value of the car on the date the car is first used for personal purposes. The annual lease value table is found in IRS Publication 15B, the Employer's Tax Guide to Fringe Benefits. For cars costing over $59,999, calculate the ALV by multiplying the fair market value of the car by 25% and adding $500. The ALV amounts apply for a 4-year period starting with the year of the ALV election. After 4 years, the ALV for each subsequent 4-year period is based on the car's fair market value at the beginning of that 4-year period. The ALV calculation includes car maintenance and insurance costs. Any gas provided by the employer is not included in the ALV. For purposes of including the gas provided in the employee's gross income, two methods can be used. One, a rate of 5.5 cents per mile can be used, or two, the fair market value of the fuel can be used. For example, if the fuel is paid with a company credit card, the actual charges are used to compute personal use, which is included in the employee's gross income. An alternative valuation method for personal use of a company car is the cents per mile special rule. This method can only be used if the car's value is less than $16,000 or $17,000 for a truck or van, and the car is primarily used in the business. Primarily used in the business means that the car is 50% or more of the total annual mileages for the business, or the car is used each workday to drive 3 or more employees to and from work in a carpool, or the car is driven by employees at least 10,000 miles during a calendar year. The cents per mile valuation method values personal use based on the standard mileage rate in effect for that year. The employee cannot be a control employee, covered next. A control employee is defined by the IRS as an employee who is a board or shareholder appointed, confirmed, or elected officer whose pay is $105,000 or more, a director, an employee whose pay is $210,000 or more, an employee who owns a 1% or more equity, capital, or profits interest in the business, or an elected official. Fixed and variable rate or favor reimbursement, not to be confused with party favors. The favor plan was established in 1992 and reimburses employees on a non-taxable basis through a combination of a monthly allowance and a per mile reimbursement. Many businesses consider this plan to be the most cost-effective method of paying for transportation allowed by the IRS. The divided plan with a fixed and variable cost component allows the plan to be more accurate than a straight mileage amount. And since the company doesn't buy or lease the car, this reduces the company's capital outlays. So how are favor costs calculated? There are two components to the cost. One, periodic variable payments. This includes the costs of operations such as regular maintenance, tires, oil changes, and gas. And two, periodic fixed payments. This pays for the cost of owning and operating the vehicle, such as taxes, insurance, and depreciation. The employee keeps track of business and personal mileage, then this percentage business use is used to arrive at the reimbursement amount. The favor rates can be based on cost information developed by the company or provided by a third party. The favor rate must be based on data that is derived from the base locality, that reflects retail prices paid by consumers, and that is reasonably and statistically approximates the actual expenses employees receiving the allowance would incur as owners of the car. The favor allowance is based on a standard automobile cost that cannot exceed $28,000 in 2016 or $31,000 for trucks and vans. Favor rules require that non-taxable payments must be made to the business driver at least quarterly. Employee must maintain insurance on the vehicle. Employee must travel a minimum of 5,000 annual business miles. And at no time during the calendar year may a majority of the employees covered by a favor allowance be management employees. Companies are required to document annual business mileage, the number of years the vehicle will be retained, model year of the employee vehicle, vehicle's acquisition costs, and proof of employee insurance. Because of all the requirements, a favor plan is more complicated to implement than other reimbursement plans and requires a great deal of administrative record keeping to satisfy the IRS requirements. Companies often use third-party administrators to manage a favor plan. Since commuting expenses are not normally tax deductible, if employees use company cars to commute to and from work, some income related to commuting must be included in the employee's gross income. In order to use the commuting vehicle special valuation rule, the following conditions must be met. The car must be owned or leased by the employer for use in the business. The employer must have genuine non-compensatory business reasons for requiring an employee to commute in the vehicle. The employer must have a written policy preventing use of the vehicle for personal purposes other than commuting or de minimis personal use, and the employee cannot be a control employee. Provided the requirements are met, the value of commuting is $1.50 each way or $3 round trip, regardless of the length of the commute. This flat rate applies to each employee, even if several employees commute in the vehicle. The commuting vehicle rule is optional at the employer's election. However, if it is used for valuing any commuting, it must be used for valuing all commuting.